Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 18th, 2022. S&P 500 currently sitting at 4437. I'm David Zarling, sitting here with two amazing technicians, Delta Dan Gorkuber and Rock Chalk Jayhawk Ian McMillan. Plenty to cover this week. Last week we talked quite a bit about the range we were in, the chop that we had seen, what we were seeing out of metals and mining and commodities. Plenty of noise this week, right, with the Fed. Everybody loves to focus on the Fed, and I'm thankful we don't have to have that in our process. But what are we seeing out of the market this week, even with all the noise?
Yes, a pretty big move down on Monday, back to the lows on most stocks, new lows for a lot of stocks Monday, even below those February 24th lows. And then they have spent the next 4 days, I guess 3.5 days at this point, just buying everything.
Yeah, what do you mean by that? When you say buying everything?
Well, I mean, everything's just been up quite a bit off those Monday lows.
So broadening out, is that fair? A little bit of broadening out. It had been a narrow market.
Yeah. I mean, now keeping it in the context of, I wouldn't say a lot of things are fixed. It's been a nice 4-day bounce.
Mm-hmm. For sure.
Yeah, you're seeing some signs of what you would want to see if we were going to have a trend reversals in a lot of these areas, right? So the divergences that many people have been pointing out finally came to fruition. Now we got to just see if it can take hold and stay.
Right. Dan, what were you going to say?
No, I was just going to comment on the breadth, definitely, certainly not fixed, but it seems like it was so bad that how much more worse could it get type of question that we're kind of all, discussing and talking about. And, obviously lots of hurdles ahead and lots of breadth. That's we still need to see, thrusts that we're waiting for and whatnot. And I'm just kind of waiting on those things to kind of check off the list if and when it happens.
Well, I think when you paint the big picture, right, since February and March of 2021, so basically a year, most stocks have been in a bear market. Now, I'm not a big believer in saying an individual stock is in a bear market. That's not really what I'm saying. What I'm saying is the majority of stocks. So when you looked internationally, China equity is getting, whether it's their technology, it didn't matter, just pummeled.
They're up a lot this week, but what does that? You can take FXI, still below its COVID lows. Now we're right back there today, but
we've covered pretty frequently on here your previously high flying areas, your IPO stocks, your SPACs, your softwares, your ARK Invest, your cannabis stocks, your clean energy stocks. A lot of growthy type names that had just been in this discounting phase for the past year, anywhere from, minus 20% in some areas internationally, minus 70%. So we've been in a bear market. Now the indices, the Qs reached the NASDAQ 100 reached that 20% threshold, whoever made that up, for what a bear market is. And we've since moved higher from there. And so was that it? Was this, because we've talked in the past about this only ends in one of two ways. We either see breadth expansion or we see the market catch down. Was this the end of the market catching down? And now we resume higher with some of these other areas that had been discounted so bad. And to give you an idea of breadth, going into this, something that we track called bullish percent was down in the 30s. So just abysmal breadth. And now we're reversing back out of that. And so is this, I think to your point, Ian, I think you said it well. Basically, do we get to be surprised if this is where the trend reversal happens? I don't think we do. They've breadth expansion.
Yeah. I sit here and I say, things aren't fixed, right? Well, That's yes, some things are like you want to take Apple. I mean, Apple's back above the September highs. Was at like 156, 157. I mean, is it like an emphatic yes, this is over? No. It's just that Apple continues to not break down. Microsoft, still above 280. But is this it?
Well, and I think to try to paint that picture, right? Because we're very visual, but here we are talking. So having to walk people through this. An example of this is a previous high flying area was software using something like PSJ. It corrected from early of last year to more recently, earlier this month, almost 46%. Okay, so you had this big correction in that area. You could see that area bounce. You could see something like PSJ move all the way back to 119, maybe even a little bit higher, but it has not fixed the downtrend. It could just be a counter trend move. And if you have a lot of areas doing that, you could technically have breadth expansion. And does it stick? Are these sustainable bottoms? We won't know this until afterwards, of course.
Yeah, and I think that's the big thing, like, especially for our clients, right? Is that like we're not in this for like bottom picking and top picking. Like we're in this for adapting to market conditions and rotating in and out of asset classes and whatnot, and finding the best risk reward at the end of the day and where that rotation takes us, right?
Yeah, amen.
And so, it definitely is just something to kind of, like as we kind of have our client portion here, just kind of make note for the clients of saying, hey, that rotational behavior and the bottom picking and the top picking it's fun to talk about, but at the end of the day, we have to be fiduciaries for them and
operate in their best interest for sure. And that's why, we don't know if this is a bottom in something like software PSJ, but an example would be a risk management tool, just identifying how important the $100 level is. And if price is below there, we would not need to be involved in software if we were. And then using these different tools for that. What kind of going down the stocks that have been beaten down the most, what are we seeing internationally? Because there's been a lot of, I would even argue, capitulation over internationally. What are we seeing internationally for equities?
Yeah.
Latin America continues to be the strongest. Canada's pretty strong. You've got Mexico breaking out to new highs today.
Mexico.
Brazil. Brazil's held up. Again, I don't know. There's some momentum, like Brazil. There's some short-term momentum. Skepticism there. I'll probably need some currency help here. Would you say that Latin America, of all the emerging market or foreign, speaking geographically here, Latin America, you think they need the most boost, like currency boost to get going compared to like a Canada, or I would say Aussie dollar probably in that too, like Australia.
Right.
And Latin America really need their currencies to be amazing.
They definitely the most dollar sensitive areas. Mm-hmm. So Latin America is definitely one of those where the dollar plays a role, and that cross plays a role. When you look at something like the US dollar versus the Brazilian real, it's at an important point right here, right now. This is a range in this relationship that goes back to 2020. If we break down here, that would be tremendous information that would be in favor of continued strength out of Latin America, because the largest portion of Latin America is Brazilian equities. So that would only continue. I totally agree with that.
Right. Well, I think another one, if we're in the currency front, of shout out to Ian Cully. He had a nice chart earlier this week on the Aussie dollar versus Japanese yen. And I know, Dave, you've been sharing some yen charts with us as well. And just the breakout of that pair in terms of just like a risk structure is quite.
Yeah. Can you break that down? If we're looking at pairing a currency pair, right? Because A lot of our clients, they're not sitting there analyzing currency pairs. That's our job, right? That's what they pay us for. So like across like Australian dollar versus the Japanese yen, can you paint the picture of what the significance would that be either direction, whether the Australian dollar is stronger versus the yen or weaker? What kind of environmental information does that provide?
Yeah, environmentally, it seems to be more just looking in past history. It does seem to be more of like a risk on if we're trending up and to the right in that Aussie versus yen relationship, right? If we're seeing new highs in that spread, it tends to be more of a risk on indicator, and especially more for the Australian type of commodities that we're discussing about. And obviously, we all know the commodity structure that we've seen recently over the past few months. Excuse me, of the strength that we've seen, right? But in terms of the Aussie versus the yen, just very much in a risk-on mode right now. If that were to reverse itself, and maybe we're back below like an 85, 86 level, then we're probably talking more of a risk-off, type situation for overall risk, right, in markets.
So another relationship that I think of, and I know Ian's been on top of this one, is just the copper gold relationship, which we know has been trendless for a while. But what are we seeing out of that currently, Ian? Copper outperforming gold being a risk on type characteristic.
Yeah, it's still in the range. I would say still no
conviction either way.
No, I mean, it's been 13 months of
oh man, headaches
for sure. So internationally, definitely saw bear markets in stocks, you name it. Of course, the Russian equities, the Chinese equities, but even Europe had some major moves, whether it was, Italy back to levels it had from inception from using a tool like EWI, which is the ETF for Italian stocks. Same place it was 26 years ago.
That's one that I think could continue to rally. I mean, EWI easily can tack on another 3%, and I'm still going to put it in the not fixed.
Right.
So now let's take something like EWI or, a lot of these, other foreign areas like a FXI. So if we don't break above, these previous periods, if we're using EWI, let's say, like I said, $31, let's get up to $31 and you stall there. I mean, there's a lot of potential to make lower. Now, obviously you can stall and do a lot of things, but I'm just saying that there's still these could be dead cat bounces. And I'm not trying to sound like I'm holding on for this last, gasp of bearishness. And I'm trying to turn over every rock that I can find. I'm just saying you could use a lot of momentum up on these moves, run out of steam, and come all the way back, right? You roll a ball up a hill and it almost gets to the top, and then it starts to stall out, and what happens?
Yeah. Right. Well, and your point, Ian, is you're just saying I can have my portfolio exposed for the move higher, but keeping an open mind that move doesn't have to have duration. It doesn't have to last. And to be open-minded, which is a character trait that should be applauded. I know that in some circles, people really, really preach you got to be married to and convicted on things, and that's not how we operate. Ian's point is our models can be aggressively long in a bounce, but understanding that we would reduce exposure again if things start to roll over, because these could just be bounces. These could just be counter trend rallies.
Yeah, and who am I to sit here and guess? I mean, you have to participate, but I don't know if the evidence is there. We're still below 200-day moving averages on the major indices.
And actually, let's talk about that a little bit. Ian, you did a great job. You were on a podcast called Fill the Gap that's a CM, Charter Market Technician Association's podcast of choice. And that was with Dave and Tyler. And you guys talked a little bit about being below a 200-day moving average. And I know Dave brought up a good point that, because I'm fond of quoting Paul Tudor Jones, that nothing great happens below a 200-day moving average. And his counterpoint to that was like, listen, like sometimes though, below a 200-day moving average, the forward returns from that are pretty good.
They can be. Yeah, they can be.
But at the same time, the markets are fat tails, right? So it's 90% of the time, yes, price below a 200-day moving average, the forward returns are great. It's that other percent fat tail event that all of a sudden, when you don't recapture the 200-day in 6 months, go ahead.
No. I think you hit it spot on. We always talk about, 85% of the time the S&P is, oh my God, data mining is just anyone and their mom just has stats on what the S&P, and a lot of it's good. I shouldn't, I'm not complaining. A lot of it's good, but there is data, coming out the eyeballs.
And I should be careful too. What Dave was saying wasn't you should be buying here.
Oh, no.
But his point was like being open-minded to the upside when price is below a 200-day moving average. And I'm totally open to that.
Well, and so my point, and it's not that I'm whining about the data, but to what you said, we talk about, 85, 90, 92% of the time after this happens in the S&P, 6 months forward or 12 months forward, all that. And I love that. I get it. But then no one wants to touch on that 10, 15%. And so do you want to go back to a client and say, well, sorry, we really thought that this was going to be like the other 80% of times. It wasn't. Right. Oops.
Right. And an example,
we got stuck in, as you would call it, the fat tail.
Yeah. Right. Because I can, and I'm sure this analogy breaks down somewhere, but it's as close as I can think of. I can get home 5 minutes sooner if I run the red lights, and I know I can get through the red lights 80% of the time. Yeah. And so, right, that means I should do it. No, it doesn't, because the fat tail event is when I don't make it through the red light.
What are the chances of a cop sitting there at the light? Probably pretty slim.
Or me T-boning somebody.
Yeah.
And hurting someone really, really bad. Same thing with being exposed to markets. I think what Paul Tudor Jones meant by nothing good happens below a 200-day moving average is the fat tail event. The event where price doesn't reclaim the 200 and it is a flush. And now you're sitting there having to wait 3 years and 100% to get back to even. So both points are valid. They're meaning that we can definitely see prices move higher from here. We have positive 6 and 12 month returns. I think of the data example you gave, Ian, and I guess this is where it would be a good pivot to. I know Grant Hawkridge and Ryan Dietrich both posted something about we had 3 consecutive plus 1% daily moves on the S&P 500. Mm-hmm. And in the past, when that's happened, we typically see on average 1, 3, 6, and 12 month returns that are higher. Doesn't have to mean it's 100%. Like for example, Ryan's data shows that 12 months later, when that happens, we're 100% of the time in the past when that's happened, we have a positive return. But any person involved with markets would understand that eventually there will always be that one exception.
Is that really 100% of the time we have positive forward returns?
Yeah. So he takes his data and goes back to 1950. And then he looks at,
this is Dietrich.
Yeah. 3 consecutive 1% gains in the past 20 years. So he's looking at the past 20 years, not the full data set. So the past 20 years, a 3-day return, positive, 1 month is positive 70% of the time, 3 and 6 month is positive 80% of the time, and the 12 month is positive 100% of the time. Now, you can make a big argument about do the full data set, which it looks like Grant Hawkridge did do. And 1 year later, 1 year later, when this scenario takes place, the market's positive 86% of the time. Now, fat tail event is the flip side. When it didn't happen, the market was, in the year 2000, and these are subsequent years, 2000, 2001, the market's down 21%. Further, 12% further in 1973, we're down 33% after that. So again, fat tails exist. These events that
Right,
quote,
you
unquote,
go on these spurts where it works for 2 decades, right? The 80s and 90s, it worked every time.
well, and it's what got long
2000s, 2010s, and up. And so, I mean, yeah, from basically the 03 bottom till, what the last instance looks like it was November 2020, 100% batting rate.
Right. And so using the full data set, it's not as conclusive. And you can't use this as I would call it environmental open-mindedness information.
For sure.
So there's no way we can use this as signal information, because if you just blindly buy, basically what Ian's saying, you blindly buy below a 200-day moving average because of the forward return data, you're going to end up in a situation where eventually it does hurt.
Yeah, you got to have a risk reward behind that component. Right. You got, otherwise, we don't go into client educations and pull out a bunch of stats that we're going to be, hey, this is where we're going to be moving your money. But
do show like Ian said, I'm sorry, process, right? We caught that 15% chance on the downside. Whoops. Right. That's not an option. So good point on that. We've talked about counter trend moves that we're seeing currently. One relationship that we like to talk about is growth versus value. What are we seeing in that relationship currently?
You're seeing a nice bounce from that relationship. I mean, it was kind of
value looks to be rolling over.
Yeah, at least just when the noise got the loudest for that,
value
right?
Versus large cap growth.
That high beta versus quality kind of beginning of the week looked like it was on the verge of kind of rolling over, and much like a lot of this stuff seems to be
small cap growth. Looking to be right, and these are very like a lot of things that since I would say January. I mean, there's been a lot of on daily charts, lots of divergences created over the last 2 months, and this relationship certainly falls into that category.
And when you say divergences,
stalls out here, if you look at small cap growth, small cap value, if it stalls out here, you pull up a weekly chart of that relationship, I think that makes sense. We've had big pivots here before.
What ETFs are you using to represent those? IWN
versus IWO.
Okay. And you're saying in that relationship, there was divergences. And when you say divergences, you mean between the ratio in that relationship and its momentum, associated RSI.
Yeah.
Yeah. Yeah. And you're right. Where
it's 0.64 level.
Mm-hmm.
That's what you want to call it. Going back to 2000. Since these ETFs were, you could certainly see just a retest, and we go into a multi-year growth outperformance again.
When that goes back to the thesis that we've talked about often, that you really have to see the large cap growth names break down consistently.
And they have. Even Amazon saved itself.
Right. And so until we see that,
for now,
bull market is still intact. And so we have some, we've been looking for capitulation, capitulation being when finally the institutions get fed up and they dump everything. And besides basically the US indices, S&P and NASDAQ. Now you could argue the NASDAQ. The NASDAQ was down 20% year to date, but they dumped everything else. And all these other areas were down 40 to 70%. And then they took it to Europe the past few weeks. And of course, everybody will be like, yeah, that makes sense with Ukraine. But was that the capitulation event that we now rise out of? We could. Absolutely could.
Yeah. Capitulation. See, and I think that is now, if we look back in 6 months and where the S&P is at 5,400, I would say from a volume standpoint, probably not capitulation-y.
Well, and let me ask you
Yeah, I
that
think
from
that's
from a
fair.
volume perspective. February 24th, gap
February
down on
24th, yeah.
was that and again, this is a genuine question. It's not like some softball setup.
Yeah.
It's was that a capitulation event? February 24th, we gapped down.
Certainly.
What does volume look at that point? Is that, in my mind, I view that as, I would guess it's a high volume event.
It's a high volume event given this relationship, but now is it a capitulation compared to January 2018 or March 2020, or, I would say a little bit more similar, actually, looking at volume here to December 2018.
Okay. So you're saying just December 2018, when we form a bottom in late December, that the volume profile is capitulation S for something like the S&P 500? Or are you looking at something different?
SPY.
Okay.
Volume. Not as dramatic as it was September 2015, 15 and what was that, February 2016, those two, that kind of double bottom.
Right.
And couple bigger days, January 2018. So obviously March 2020 and even 2010. So, you go back to, 2010 volume was nuts during that correction in August and that range through October.
Okay.
Sorry, 2011.
Yeah. Okay. So it has the potential to be capitulation like. Go ahead, Dan.
Oh, no, all I was going to add was just kind of bringing it back to, I think that's a good question of, like you bring up a really good question of, was it, we could probably argue that January 24th was a capitulation event in terms of, price and volume. And then was it kind of tested again on another capitulated type of event on, that February 24th, 1 month later.
January, I see. January 24th is interesting.
You take those 2 days with really, pretty decent volume, right? Not as good a volume as, what Ian was just talking about with some historical.
But given
levels,
this environment, big.
Yeah. Exactly.
Given the last 2 years, definitely not arguing. That's big volume.
So what would you consider? So for example, if you guys could pull up VEU, which is a chart of the Vanguard All World Stock Index, and it takes the US out of it, so it's a very international index. That capitulation, is there capitulation early March, or was it more in February, that February 24th, or was it more recently at the lows of March 8th? And I know we're just picking hairs here. It's just an interesting.
That's a great question. And then is it, right? This is harder because you don't see it build like in other environments. These are kind of 1 and 2 day spikes.
Yeah.
This is not cascading price with volume that's just going parabolic.
Right. And I think when you combine the just abysmalness of stocks over the past year for the majority and just abysmal breadth, these dumping of international stocks, the Qs even reaching, the NASDAQ 100 even reaching minus 20%. And then you look at institutional cash levels, which are, using a chart that David Cox shared, and it was from Bank of America Global Funds. And just the institutional cash levels are as big as the COVID bottom in April of 2020, as big as that late 2016 period, or even December 2008. Pretty large cash levels. Now, this goes back to, this is not signal information, because cash levels were pretty big also summer of 2000. So it's just interesting that you could potentially have a situation on your hands where, if institutions to decide to chase this and they view this as they can't get caught holding so much cash and they deploy it, it would take us higher, right? That's future fuel, takes us higher. It's just interesting. It's an option.
Very
But-
much so, yes.
Man, you look at something like VEU. I mean, you zoom out on that thing 10 years.
Mhm.
Big move this week. You buying that here?
Yeah, there's always the
That
question
looks
of
like, I mean, that just looks like a heck of a
Yeah.
horseshoe top. Very similar to 2010, 2011.
yeah, like is this move just a bounce, right? Because maybe we talk about that in the extended portion. Let's talk about some of the weekly data that we're seeing from a candle perspective across all things. We'll leave that as a teaser, and we'll come back to that. Yeah,
All right.
teasers got to have it, right? Got to keep the people interested. Anything you guys want to touch base on the client portion before we jump into that more in the weeds in the extended portion?
I don't have anything other than, we are still range bound. I think one of the big things I'm waiting for is Russell 2000 to get back in that range on IWM. That's 209
Mhm.
to probably 211-ish to feel real comfortable about it.
Yeah.
But until then, I mean, we have been here multiple times over the last couple months. We've come back up to 206, 207 and failed. So moving averages are still bearish. Still in downtrends in most things. So
Yep.
willing to participate, but not necessarily running around trying to find loose change to buy everything in sight. I will say that.
Not stepping in front of the bus to pick up the penny.
Not the bus. Maybe next week.
Okay. Dan, anything?
I would say maybe just, especially for clients, just to kind of realize like, hey, it's always, for us, it's always an if then statement, right? In everything we're looking at, every day we come in, it's always an if then statement.
Mhm.
When we look at these markets, and we want to project that and apply that each and every day. So
Absolutely. Amen. Appreciate it, guys. Dan, it's been great to have you here in person at the office for the last 2 weeks, grinding with Kevin and getting trained up on our processes here. So it's much appreciated. You've exceeded my expectations. So thank you for that. It's a blessing for our clients. And Ian, like always, tremendous work this week. Appreciate you as well. We hope you all stay on for the extended portion.
Have a great weekend, everyone.
Have a great weekend, everyone.
All right, gents, jumping into the extended part of the podcast, we kind of left off with VEU as an example, the Vanguard All World Index moving out of, or excluding US stocks. And Ian, you were talking about, pretty fantastic week. So we've got a bullish engulfing on it. But your point is that where you're adding new money?
Yeah, I mean, it's certainly something where if you are covering, right, I would say, I'm pretty thankful. I would say that we covered more so, a majority of our shorts in time, if not all of them. And we're able to get back into exposure. Now, with some of these weekly candles, yeah, that's a great question. In China, are you buying a 35% bullish engulfing candle on Alibaba?
I mean, even FXI is a 14%.
And I would
bullish
say that's
engulfing.
not, Alibaba's still below some huge behavior levels.
Yeah, and at the same time, FXI, you could argue buyers definitely stepped up. Well, buyers stepped up or shorts lifted around 28.74, right? That's a level on FXI that goes back all the way into 2011. So you could, but your risk reward is hard because if you're buying here, you better have your stop pre-identified. And what is it?
And so you take Alibaba, been in a downtrend since October 2020, long before the average stock in the world. That began 5 months later. I mean, so this downtrend, right, we have an old call rate of trend going from the highs and then through those highs in February 21. This stock has been below a 200-day moving average since, February, March 2021. I mean, this is a massive bounce that could continue to go for 5 months. This could easily go back up another 20, 30% just to see it roll back over and still be in line with its rate of downtrend.
Yeah, still being a downtrend.
It's so crazy when you get extended from your rate of trend, if we want to use moving averages.
Right.
Coming back, right, as you would say, Dave, the rubber band snaps. And yeah, we do come back, but it's the momentum is still squarely to the downside. It's not like Alibaba's been overbought on a daily basis yet.
Yes, correct. I mean, all you've seen is repeated.
All we see is, just oversold for, since this whole thing started.
Yeah. Selling down and seeing RSI down in the 20s.
And you didn't even get a new RSI high off of this.
Yeah.
This is just an extremely strong downtrend. And we've seen these rallies before in Alibaba. It's rallied during this same downtrend. This past October, rallied 32%. It's just that it didn't happen in 3 days.
Right.
And so people weren't as excited about it. But it's the same behavior. It just happened quicker. It doesn't mean anything's fixed.
Right.
All right.
And that goes back to, the way many people think that, for example, a bull market ends with a bunch of new sellers when it's really just lack of buying, and that all that's left is selling. And the same thing with some of these moves. Could we come back 6 months from now and we're higher because this was just exhaustive? Like this move was exhaustive and we just ran out of sellers.
Yeah.
And it could be that we just ran out of sellers. But to your point, you could bounce Alibaba back up into 131 and then it continues its course downward and it doesn't really fix anything.
Well, and it goes back to our point we made a few podcasts ago of, okay, let's look at the value line geometric New York Stock Exchange Composite, Russell 2000, whatever your choice to get a view on the average stock, right? So is it accumulation? Is it distribution? All these break down. So we say, okay, let's say in theory it's distribution. Institutions spent 9 months selling stocks.
Right.
It goes back to, you think because of some 3-day pop that they're now super eager to throw trillions of dollars back in equities? I just don't think that that's how it works, to be honest. Well, I don't think they care about your low volume, short covering 4-day rally.
No. Well, and what would be interesting is if they did take, using VEU again, over a year of distribution to get out of their positions, and then everybody threw in the towel in January and February here. So there are no sellers left.
That's true.
And it just melts higher. And right now on VEU on the daily, you have an island reversal in place.
A lot of that in Europe, we noticed. A lot of that. Germany had now I think Germany technically came back down in its little, but that one actually it was the same island location that we saw in October 2020, which, that led to a massive rally.
And so if something like VEU gets back above $59-$60, was that some massive false breakdown and we're moving higher? Could be, but I'm with you too. Like, you definitely have this horseshoe type distribution.
Look at emerging markets. Look at this. Does this fix anything? EEM rallies another 7-8%, just comes back to its rate of trend.
Yeah.
And you get another waterfall.
Well, and that goes back to, like, if people remember the selling that happened in the great financial crisis, there were massive bounces that didn't fix anything. There were 20-30% moves.
Multi-week, multi-month moves.
Right. Like November 2008 into January of 2009 in something like the S&P 500. That was a 25% move. And
you recaptured some big, let's go back. So it's April 2008. S&P gets back up above 1400. let's call it 1380, 1400.
Mm-hmm.
You're breaking a rate of trend, right? You break a rate of trend. I mean, you're kind of in the clear, right? From okay, here we go. Things looking pretty positive. Like you said, we're coming off this 15% rally, and then they take it right back down.
Mm-hmm. So if that were to take place in the current environment, you would expect the ratio of Qs, NASDAQ 100 versus the S&P to break this horizontal level. That's pretty important. So if we're going to do kind of what you're talking about, that 2008 reclaim in spring only to fail, when you look at financials, which were the leader back then, they still failed. They kind of gave you the clue. And so I think our clue would come from that Qs versus S&P relationship.
And it failed to fail. I mean, we saved itself.
Yeah.
Last 2-3 days. So now you're back to looking, right? This lines up to what we were talking about in our growth versus value in the client section.
Mm-hmm.
Are you back into large cap growth?
Yeah.
Growth in general.
And it's a range that keeps going. Like there's a pretty low risk, high reward scenario upon us where you have a bullish engulfing in the Qs versus
Wouldn't that
S&P.
be something if we just trade back up to the top of this range?
It's a 10% alpha range with very minimal risk in that relationship. And you would have tremendous information on your hands if you were back below the relative, the ratios prior lows. If you're back below that scenario you're talking about, Ian, where broadly things fail again, definitely on the table.
I mean, I think that's an incredible risk reward. If you are looking for a sign to get back involved in large cap growth, I think the relationship that you brought up, this Qs versus S&P, looking at it right now, if we were to close the market in 2 minutes,
mm-hmm.
and you look at the RSI divergence that's developed over the last 2 months, RSI making a new high and now back above 50, which is a pretty bullish sign. I mean, that's the start of entering a bullish regime from momentum. Yeah.
Just when the narrative and noise was everything about value,
and oil and
all that stuff, and all of a sudden,
and rates, right? So of course rates are going higher. Well, why? Banks have stalled out.
Mm-hmm.
Banks have not kept up with rates.
You brought up JP Morgan.
JP Morgan looks absolutely abysmal to me, below $146.
And I think what we love about charts, what we love about supply and demand, is that Qs versus S&P chart is about as clean as it gets.
It is.
And that can drive your thesis. So if you're above these relative lows in that relationship, gonna be really hard for the market to continue to roll over here. If you're going to see the NASDAQ 100 lead from here, it's going to take broad indices with it. Whereas if you were back below that, then yeah, the bear market continues. I think it's that goes back to that if this then that binary thinking and process that Dan was talking about that we're adhering to. That's probably the cleanest chart that we can give an example of that. Any other ratios or relationships that you guys are looking at? And I'll leave it open. Like if you guys want to talk about weekly candles, you want to talk about ratios, have at it. What are you guys seeing that sticks out to you in your mind?
I say currently? High beta versus low vol.
Okay.
Continues to move. That's similar to Qs. We had a failed range breakdown in that relationship. It fixed itself.
Yeah.
Still, I'm not going to say that it's in the clear given the trend. I mean, it's messy, but it saved itself. It stopped going down.
That's a good point.
Small cap, equal weight and small cap tech. Equal weight tech is it. There's just so many divergences that seem to be playing out, and it's in the favor of growth investors, to be honest, wherever you look.
Well, wouldn't that be fascinating with treasuries breaking down and rates moving higher? That isn't the narrative supposed to be if that happens, that's bad for tech. And here, like maybe that's priced in already and tech moves higher from here. Dan, go ahead. I interrupted you there. Go ahead.
Oh, no problem. Yeah, no, that's your point there is that'd be something. I think like when you take something like VYM, so that's Victor Yellow Mother over SPY, and then kind of compare that to like the momentum ETF MTUM versus SPY. I mean, just on the last 5 days, I think there's almost close to like a 5% performance difference there in alpha. So VYM being more of like our high dividend yield type of ETF, right?
Mm-hmm.
That has held up really well, with the whole value outperformance situation. But in that relative ratio, you're right, coming towards more of a consolidated high, if you will, where, the momentum versus SPY ETFs in that ratio specifically, again, kind of like what we harped on, finding more of that reversal type characteristic. But I think another one, that we've kind of talked about this week is across the team is just that the IPO ETF versus SPY. Blow that one out long term, right? And you're seeing some pretty critical levels where that inflection point, if I bring that chart up here.
Yeah, not random, right?
Not random at all. No. So, and that,
yeah,
again,
pretty amazing.
It doesn't fix anything, right? Like we've talked about, it hasn't fixed anything.
Well, that's another example of that ratio could travel another 20% on a relative basis. So 20% alpha and reach some important levels where it hasn't fixed anything really big picture.
Right. Yeah.
So you could see these old flying names, high flying names, which have been so beaten down, no longer high flying, whatever you want to call that, the opposite of high flying, return to that type. And people would think everything's back. And that's why we call it a relief bounce, right? These could be relief bounces. They feel really good, but 6 to 12 months from now.
Yeah. Who doesn't feel good about seeing Square up 16% in 3 days? I mean, right? I guess it's called Block now. I forgot they changed their name, but
yeah, good point. Like
these are the things that get people
fired up,
right? Because people, it's like sports fans. People are fans. They're fans of stocks, right? These things that they believe in. I mean, they've got so much emotionally and monetarily. And people are just fans of stocks. They're fans of the products, things like that. And so, your team's been on a losing streak and they win a couple games here in a row and you get excited. I do it as a sports fan. Thankfully that has not transitioned to my portfolio management mindset, but it's just total human emotion to see, green shoots in some of your favorite names and here they come. And get excited and
well, yeah. If you're a hodler of Block, right, and you've been holding,
hoping it. Yeah, maybe you're just more hoping.
Yeah, if you've been holding on a 60% drawdown, and it comes back, now you're like, see, I knew I was right. Like I just need to hold on.
Well, I see that all the time with AMC and GME. You go through Twitter and see people. It'll be up like 5% in a day, and we're sitting here on GME at $91 and it'll be up 6% and people be up. See, this is why I didn't sell it. This is why I didn't sell at 300. You wouldn't understand. I mean, it's like crazy to see the justification and that every little blip on the radar, is going to lead to some big turnaround.
That's not healthy. It's like that. Seems like a hopium drug.
Unhealthy.
Fine hope, hodling. All right. With that, bumping up against the end of the podcast, anything else from you guys before we wrap it up?
Nothing from my end, I guess.
Yeah, just nothing. I mean, a heck of a melt up this week. Gotta give it to. It's nice to be participating and not sitting here watching it or trying to chase. So we'll see what it turns into. Not a huge believer. We get another good week next week or even Monday. Let's see if we have a good Monday. And
Yeah,
we
day
can
by
come back
day,
and-
day by day. Nothing wrong with that. Who you guys got in the tournament? Who you got? Who's your champ?
Kansas. Always.
I think I picked Gonzaga.
Okay,
Ooh,
Gonzaga.
they had a tough time yesterday.
They did.
Yeah,
That was a little too close for comfort if you're a Zags fan.
right.
That's awesome. So Kansas, Gonzaga. I've got Arizona.
Arizona. Okay.
Arizona's an athletic bunch.
They are.
I like them.
They're good. They're like the one seed that no one, the media never talks about Arizona. I've seen zero coverage of Arizona this year.
And they're legit. I mean, they know how to ball. I watched a couple of their games, and I mean that doesn't mean anything in the tournament, right? Because anything can happen. But all of those teams, man, I would watch
Kentucky.
any of those guys on the championship.
Sorry, Kentucky fans.
Kentucky
that was
ticket. Bounced Iowa too. But that's one of my favorite times of year. A little bit of March Madness. It's fun to watch. Just tremendous athletes and coaches do their thing and compete at a high level. And that's markets, right? It's competing at a high level in the most competitive arena on the planet. And so we're going to continue to do that on a day-to-day basis. And that's why I just love having you guys on our team. Nobody else I want to compete alongside with than you guys. So thank you for your insights and knowledge this week. And next week we'll either be off or it'll be an abbreviated version. We'll make a determination, let you guys know either which way. But we appreciate you guys, everybody listening, and the feedback. It's awesome. Thank you.
Have a great weekend, everyone.
Thank you, everybody.